So traders weighing how long the economic disruption will be if this shutdown drags on. And also the question is, will it delay key jobs data this Friday, which many in the market use as a guideline for monetary policy and inflation? Let's get more from Gary Schlossberg, global strategist at Wells Fargo Investment Institute. Gary, always great to see you. Thanks very much indeed for joining us.
Thank you.
You've been around for a while and you've seen these shutdowns come and go, and they weren't cataclysmic for the market anyway.
No, they weren't. Even the longest on record, the 35-day shutdown between December 2018 and late January 2019. We did see some losses initially for the economy, but those were made up largely as the government reopened. We think we'll see much the same thing this time around, perhaps a somewhat bigger impact. More of the government is shut down, but again, a bounce back once the government reopens.
What about this absence of jobs data? Will that be a huge deal? I mean, it's just 1 month.
Well, it does mean that the Federal Reserve and investors do lose a certain amount of visibility. But as we saw today, there is a fallback. Coincidentally, there are a number of private-based employment numbers that are coming out, beginning with today's report, ADP employment in the private sector. Tomorrow, we get the Challenger Gray layoff announcements. We may even get initial jobless claims, though they won't be seasonally adjusted. And then the focus, I think, will be on Friday's release at 10 o'clock Eastern time of the purchasing managers survey, that is the ISM survey of the services economy. And as we've seen from today's action, the market will be falling back, we think, in all likelihood, on those numbers for guidance on where we are in the job market and the broader economy.
How do you feel about the market right now, Gary? Does it seem inflated? I'm talking about these massive investment plans in AI-driven data centers. Of course, not all of them will be built.
Well, a good part of it, I think, is fundamental. We have AI. We have other capital spending that we think will benefit. We have an awful lot of stimulus coming into the economy next year, deregulation, the cumulative effect of that. We have tax refunds as part of the July reconciliation bill. We could even see some $200 billion in refunds to companies later this year or early in 2026. If, as expected, the Supreme Court rules against the Trump tariffs, forcing a refund of the many of the tariffs that were enacted earlier this year. So there is a tailwind for the market. Maybe valuations are fairly on the upside, Rich, but with the Federal Reserve cutting interest rates as well, ample liquidity, certainly a good fundamental case for the market as well.
And September can be rough, but it was just fine. We saw the market hitting new highs.
Well, it isn't over till it's over. October, while we've seen gains on average seasonally, a bit of a tailwind, has been among the more volatile months of the year for the market. We certainly did receive that opening jolt from the government shutdown. The market seems to have withstood it pretty well. And with these other tailwinds out there, that could have the effect of muting the kind of volatility that we've been accustomed to for October.
There's sectors of the market that you're avoiding right now, Gary. I mean, are you lightening up on these famous Mag 7 stocks?
Well, we are a little more cautious now on communication services, more tactical than fundamental. The long-term outlook for communication services, keyed as it is to artificial intelligence, we think is a good long-term play. But for now, at least, we're trimming in that area. We're certainly trimming in the energy area as well. But on the other side, we are very favorable, most favorable toward financial services. We still view favorably, given the AI outlook and the effect that it's having on those sectors, both technology and utilities being driven by the power needs there as well. So caution, we're focused on quality, we're focused on liquidity and the large cap and to some extent the mid cap sectors at the expense of small caps. But we do think that the environment is still pretty conducive to the market at the moment.
What about earlier this year? We heard about some investors were lightening up on U.S. assets because of unpredictability, even capricious policies in the White House, and that some people were retreating from the U.S. exposure. Do you think those fears have eased?
Well, I think they've eased as it's become clear that some of the fundamentals driving the market remain in place and will continue to remain in place, we think, in 2026. Starting with economic growth, we think growth here will exceed the rate that we're seeing relative to its norm overseas. Emerging markets, we're looking at a little less negatively now, more inclined toward a neutral stance, but we still think that the U.S. will be among the key locomotives for global economic growth next year, with the Federal Reserve cutting interest rates that may work against the dollar to the benefit, to some extent, of overseas economies, but works to our benefit as well. So I think the fundamental environment for the U.S. continues to favor U.S. stocks relative to certainly developed country markets after that bit of turbulence we had earlier this year.
Gary, leave us with a final thought. The balance of 2025, is there something investors should be wary of, or is there something in the market that you think is being discounted or ignored unduly?
Well, geopolitical tensions certainly are out there. They could have a short-lived effect on the market or a more enduring effect if it affects the economy, trade flows in any way. The financial markets are highly charged. We're keeping an eye on that. If there's any surprise on interest rates that could work against the market, have a magnified effect on interest rates. And of course, the government shutdown, the ultimate effect of that, permanent layoffs, recessions, pullback in government spending could be an issue in economic growth down the road. We think that we'll be overshadowed by the positives, but we're certainly keeping an eye on each of those developments.
Gary, thank you very much indeed.
Thank you.
Gary Schlossberg is global strategist at Wells Fargo Investment Institute.